So I recently wrote an article about why high yield savings accounts aren't an adequate way to build long-term wealth, and this caught a lot of traction. I think a large part of why is because of the recent shifting rate environment and the implication it has for investors with high yield savings accounts.
And I guess historically savings accounts were paying, 5-6% not too long ago. So what's changed?
So for the past few years, savings accounts have been somewhat of a haven for the cautious investor. Then the RBA slashed rates 3 times last year and then recently decided to raise rates again. This has several implications for people parking a lot of money in their interest account for their long-term sort of wealth building. You'll find plenty of financial institutions now advertising higher rates than before. I think it's important to note that these appear appealing on the surface, but they have implications for people using cash as a long-term strategy.
And you mentioned implications. So what are some of these implications?
So firstly, the RBA has changed their headline inflation outlook. They've gone from about 2.5% to 3% to now 4%. What this means is that your real returns will be marginal if your only wealth building strategy is a savings account. If your account is offering 4.5%, 5% and headline inflation is 4%, we see how this return is not a viable pathway to achieve long-term wealth.
What's the obsession with savings accounts then?
Look, I think there's definitely a behavioural angle here. Loss aversion, which is the assertion that our losses hurt us twice as much as equivalent gains, is a big one, right? Especially those investors with lower risk tolerance, less confidence, or simply just less time in the market. My counterpoint here is that if you're scared of losing money in the market, the same goes for savings accounts and long-term wealth. Even though savings accounts might feel safer psychologically, inflation over the long term, especially if it's high, means that you're actually losing money anyway, which is what some people are afraid will happen if they invest in the share market.
Well, is it fair to say, though, that cash still has a place in a portfolio?
Yeah, for sure. I think cash definitely has a place. If you're still establishing an emergency fund or you have several short-term goals you want to achieve, then I think cash is one of the best tools you can have to achieve that. I think the main point I want to make here, besides the things I just mentioned, is it's not really a robust wealth building strategy, right? Hypothetically, if inflation were to sort of average 3 to 4%, your real return is marginal. In comparison, if we look at the ASX 200, over the past 3 decades, it's returned about 9% before inflation. So when you hoard cash beyond what your goals require you're really foregoing that extra return you could get elsewhere, and therefore foregoing achieving some of the goals that you set for yourself.
So my final question, how do people actually make the shift into investing?
I think there's a prevailing narrative about investing, right? Especially because we're seeing so much volatility. I think the point to underscore here is that investing isn't gambling. Investing is not making high conviction bets and having to constantly monitor your portfolio. Reframing this is really the first step to gaining confidence. From there, it's understandable that people might have a hesitation with putting a large chunk of their cash from their account straight into the market. Entirely understandable. One good way to do it is to follow the dollar cost averaging method. What this sort of stipulates is that you have a chunk of money, you put it in set intervals over a period of time. What this does is it not only builds confidence over time, but it also helps reduce the risk of mistimed entrance.
This video has been prepared for clients of Morningstar Australasia Pty Ltd and or New Zealand wholesale clients of Morningstar Research Ltd. Any general advice has been provided without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.